Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into a comparative analysis of the mechanical and electrical contracting sector. We're looking at four specific names: FX, EME, IESC, and LMB.
Yeah, this is a really fascinating space right now. We're talking about the companies that install, well, the guts of the modern economy, really.
Yeah.
Power systems, cooling, all that specialized wiring. It's a sector that, usually just tracks GDP, but things are different now. It's being completely reshaped by these huge, undeniable secular trends.
Right. And our mission today, using this stack of sources, we've got earnings call, strategic reports, the lot is to figure out which of these players is best set up to ride those waves. And crucially, where the risks are hiding, because they're not always obvious. These companies range massively in size and how they approach things.
Absolutely. We've got everything from like a $33 billion giant down to a sub-billion-dollar specialist, all chasing the same projects, the same skilled labor.
So to really understand the comparison, we need that foundation. You mentioned these huge forces. You called it the triple threat drivers.
That's right, the triple threat drivers. It helps explain why demand in M&E contracting is just, well, outstripping supply right now.
Okay, let's break that down. Driver number one.
Yeah.
This is the one grabbing all the headlines, right?
Yeah, number one is the most immediate, the most obvious catalyst: data center demand. I mean, it's just an unprecedented build-out of absolutely mission-critical infrastructure.
Yep.
And AI, artificial intelligence needs, have just thrown fuel on that fire.
So when we hear AI boom, we should be thinking about the physical limits: power, cooling.
Exactly. Power and cooling. Those massive server racks full of incredibly hot, power-hungry chips. They need specialized mechanical and electrical systems. And our sources are clear. This demands innovation, speed, scalability from these contractors.
Yeah.
It's priority number one for revenue for pretty much all of them.
It's just the sheer scale of electricity and cooling needed. It's warping the whole sector. Okay, that's the immediate driver. What about driver number two? You said this one's more structural, longer term.
Yeah, driver two is this multi-decade theme: electrification and energy transition.
Yeah.
And it ties really closely into bringing supply chains back home. Reshoring, nearshoring. We're not just talking solar panels here. Think high-tech manufacturing, especially semiconductor fabs. Those things require unbelievably complex, precise MEP work.
Fabs, right. And battery plants too, grid upgrades.
All of it. Battery plants, modernizing the whole industrial base, upgrading the grid to handle things like widespread EV charging. This provides a really stable, long-term base of high-value projects. It's less tied to, say, the immediate whims of the tech cycle. It's strategic national infrastructure.
So it's not just tech pushing growth, it's fundamentally remaking our industrial capacity that needs these specialist contractors.
Okay, and the third driver, the unsung hero. Precisely. Driver number three is aging infrastructure, which leads to a ton of renovation and repair work, R&R. This is the, let's say, less glamorous but absolutely essential work: maintaining existing critical facilities.
Like hospitals, utilities.
Exactly. Hospitals that absolutely cannot afford downtime. Utilities needing retrofits. Even existing data centers that need system upgrades. Any complex building system, really. It might not make headlines like a new billion-dollar fab, but R&R is a crucial source of recurring, reliable revenue, and often high margin, too.
Why high margin?
Because it's non-discretionary. If the power system in a hospital is failing, you fix it immediately. Cost becomes secondary to uptime.
Okay, got it. So the drivers are data center, new builds for velocity, electrification, and new industrial capacity adding complexity, and R&R maintenance providing resilience. That's the framework. Now let's see how these four players, FIX, EME, IESC, and LMB, are positioned to attack these trends, because their strategies seem really different. Okay, let's kick things off with the giant Comfort Systems USA, FIX. Market leader by value, right? Market cap around, what, $33 billion?
Yeah, $33.0 billion. And a very solid operating margin, 11.2%.
So if we're looking for their competitive advantage, their moat, where is it? What defines FIX?
FIX is absolutely positioning itself as the modular powerhouse. That is their moat. They are betting big, aggressively on proprietary modular and fabrication capacity.
Modular, meaning building big chunks in a factory first.
Exactly. Their core strategy is shifting that skilled labor away from the chaotic and labor-constrained construction site into a controlled, productive factory environment. It's all about optimizing labor productivity. It's their main answer to the industry-wide labor shortage.
That sounds like a huge capital bet. How much are they leaning into this?
Oh, massively. Modular already makes up 17% of their revenue year to date. And get this, they're planning to have 3 million square feet of modular capacity online by early 2026.
3 million square feet. Wow, so this isn't some small experiment.
Not at all. This is scalable execution capacity built specifically to meet that urgent data center and complex industrial demand. Speed is key. Their main revenue stream is still new construction. That's about 61% of total revenue. But crucially, the tech sector piece of that is growing fast. It hit 42% of revenue in the first 9 months of 25. That's up significantly from 32% the year before. They are right in the thick of the immediate demand.
With that kind of focus, I bet their visibility is pretty strong.
It is. They're reporting a record backlog, $9.4 billion. And what's interesting about that number is the duration. Management specifically noted their modular bookings are pushing out further, some projects starting as far out as 2026.
So these aren't just handshake deals, these are long-term commitments.
Right. Big customers locking in that capacity because they value the prefab speed-to-market FX offers. Now, the key risks are just the flip side of that strength. Heavy exposure to the new construction cycle makes them vulnerable to cyclicality if that pipeline ever slows down. And, like everyone, wrestling with skilled labor constraints, even with their internal training programs.
Okay, so FX. High growth, high volume, modular focus, but with cyclical risk. Let's move to the next big one, EM Core Group, EME. Slightly smaller market cap, around $28.9 billion, and their operating margin is a bit lower, 9.4%. If FX is modularity, EME feels more like sprawl.
That's a good way to put it. EME's moat is absolutely geographic scale and diversification. They're really a platform company. They operate through something like 100 different subsidiaries all over the country, and they serve a really broad mix of sectors.
How do they break down their business?
They split it between services, that's about 24% building services, 9% industrial services, and then construction. Their M&E construction business is huge. They're now active in 17 distinct data center markets. Just think, that was only 4 markets back in 2020.
17, that's incredible growth.
It really is. And this huge footprint, this multi-subsidiary model, lets them handle smaller, maybe less cyclical projects too. Sources say about 46% of their electrical and mechanical construction revenue in 2024 came from projects under $10 million.
So they're diversified not just by geography and sector, but also project size. Seems like a stable giant. What about their visibility? And maybe more importantly, why is their operating margin noticeably lower than FX's 11.2%?
Visibility is excellent. They report RPOs, remaining performance obligations, of $12.6 billion. That's a massive forward look at contracted work.
RPOs, that's basically their backlog, right?
Essentially, yes. It represents work they're contracted to do, and it's well-balanced, 51% mechanical, 35% electrical. Now, your point on margins. The key risk, and it's structural for EME, is their heavy reliance on M&A, acquisitions, for expansion. Think of that big $868.6 million deal for Miller Electric.
Okay, so buying growth, why does that hit the margin?
2 reasons. First, it requires constant, effective integration across dozens, even hundreds, of these subsidiary companies. That's complex and costly. Second, and this is crucial, it results in a significant ongoing amortization expense.
Right, let's unpack that amortization for the listener. What does that mean practically?
Okay, so when EME buys a company, they usually pay more than the value of just the physical assets, the tangible stuff. That extra payment, that premium, gets recorded on their balance sheet as intangible assets. Things like goodwill, customer relationships, brand names. Accounting rules then force them to systematically expense the value of those identifiable intangible assets over time. That's amortization.
And it's a big number.
It is. Our sources show amortization was nearly $87 million just for the first 9 months of 2025. That $87 million is a mandatory non-cash charge, but it directly reduces their reported operating income, and therefore their margin. It structurally pushes their margin down compared to a company like FX, which grows more organically through internal investment, not constant buying. Investors really need to factor that drag in.
That's a critical difference. Okay, shifting gears now. Smaller company, but higher margin. IES Holdings, IESC. Market cap $7.6 billion, but that operating margin is impressive, 12.5%. What's their niche? How are they doing that?
IESC is the focus technologist. They aren't trying to be everywhere like EME. Their moat is deep technical and fabrication specialization. And right now, that's being massively driven by the explosion in data center work design, build, maintenance within their communications infrastructure segment.
So they're not just pulling wires, they're doing more specialized stuff.
Exactly. They're not just installing commodity pipes and wires. They specialize in custom engineered products, things like pre-built, custom generator enclosures specifically for data centers, complex communication systems, specialized power setups, that kind of thing.
And that technical focus is really paying off for them now.
Hugely. Their communication segment is the main growth engine right now. Get this, 55.6% revenue growth year over year in Q3 2025 alone.
55%. Wow.
Yeah, and it's almost all driven by data center demand. And that specialization, it flows right to the bottom line. Gross profit margin in that segment jumped sharply from 19.3% up to 24.4% in the same period.
Better pricing power when you offer something highly specialized that everyone needs now.
Precisely. What does their visibility look like? And what's their big risk?
Their RPOs are smaller, $1.18 billion, but it seems very high velocity. $1.01 billion of that is expected to hit revenue within the next 12 months.
Right, that indicates a really short cycle, high burn rate.
Yeah.
Pretty typical for specialized installation work. Their unique risk, though, it's specific and it's critical. Governance.
The governance. How so?
Tontine Associates and related entities control about 55% of IESC's common stock. That level of ownership concentration is a massive red flag financially.
Okay, let's not gloss over that. Why is one dominant shareholder potentially such a disaster?
Well, think about the mechanics. That concentration could trigger what are called change of control provisions in their really important agreements, specifically their credit lines and, even more critically, their bonding capacity.
Bonding capacity.
Okay.
They need performance bonds to get big contracts, right?
Essential. You can't bid on large construction projects without them. So imagine Tontine suddenly decides to sell a big chunk of their stake. The lenders, the bond issuers, they might suddenly view IESC's stability as compromised because ownership changed significantly. They could potentially pull credit lines, demand immediate debt repayment, or crucially revoke the ability to issue new performance bonds.
And if they can't get bonds,
They can't bid on large projects. Revenue basically grinds to a halt. It moves the risk from just operational to potentially existential.
that is a serious overhang. Okay, finally, the smallest player here, Limbach Holdings, LMB. Market cap just $0.9 billion, under $1 billion.
Yeah.
Yet somehow they have the highest operating margin of the group, 13.5%. That scale and margin screams a totally different strategy.
It absolutely does. LMB has pulled off a really dramatic strategic pivot. They've moved heavily into recurring renovation and repair, R&R work. They do this through what they call owner-direct relationships, or ODR, that ODR model. That's their entire strategic moat now.
Owner-direct relationships. So working directly for the building owner, not through a general contractor.
Exactly. And it's working.
Yeah.
In the first 9 months of 2025, ODR was 74.1% of their total revenue. They hit their strategic target range of 70–80%. They are consciously shifting away from those one-off transactional construction bids. Instead, they're focusing on becoming that indispensable recurring maintenance partner for complex facilities, hospitals, life science labs, operating data centers.
How does that fundamentally change their profitability? Why is that ODR work so much more profitable?
The quality of the profit is just superior. You see it right in the numbers. Their ODR gross margin was 27.4% year-to-date 2025. Compare that to their traditional general contractor relationship work, GCR, which was 23.3%.
That's a big difference.
It is. ODR work, like being the on-call heart surgeon for buildings' critical systems, commands a premium. The work is non-commoditized, it's service-based, it's mission-critical, often urgent. They get paid to keep the lights on, keep the systems running. That generates reliable, superior cash flow compared to the more cyclical, lower-margin world of bidding on big new construction projects.
Okay, but if that ODR work is often short cycle, quick turnaround, does a traditional multi-year backlog even make sense for LMB?
No, not really. And management is very clear about this. They say their reported backlog is intentionally not a reliable indicator for the ODR side. Why? Because that work is so short cycle, so quick turning, it's often completed before it even formally hits the reported backlog number.
So where does their visibility come from then?
It comes from the stickiness of those recurring relationships, from renewal rates, from being embedded with the client, not from a long-dated contract number.
Makes sense. What are the unique financial risks tied to this model for LMB?
Two main ones stand out from the sources. First, a unique exposure to MEPP liabilities. That's multi-employer pension plan liabilities.
Okay, pension liabilities. How does that work?
They participate in about 50 of these multi-employer plans. That means they, along with other participating employers, are on the hook if any of those plans become underfunded. It represents potentially a large future financial liability that needs constant monitoring. It's a long-tail risk.
And the second risk?
Near-term margin dilution risk coming from acquisitions they make for growth, like the recent Pioneer Power deal. While these acquisitions might be strategically sound, the acquired companies often come in with a lower margin profile initially. So management has to prove they can successfully integrate them and lift their margins up to LMB's high ODR standard. Otherwise, overall margins could dip temporarily.
Okay, we've laid out the four companies, their strategies, their financials. It's clear they're all benefiting from those big macro drivers, but attacking them in very different ways. Let's try to synthesize this. How are they specifically exposed to this massive AI infrastructure build-out theme?
Right? It's not just one thing, AI exposure. It's really a spectrum.
Yeah.
You've got, like, the company building the physical box the fastest, the one handling the super complex cooling inside, the one providing critical custom gear, and then the company that keeps it all running for the next 20 years.
Okay, so let's place them on that spectrum. Start with Ethics, the highest volume player.
FX clearly has the highest volume leverage to the boom. We saw that 42% of revenue tied to tech and industrial. Their whole game is speed and capacity. They are literally set up to build the new data center boxes faster than anyone else, thanks to that massive 3 million square foot modular capacity coming online. They are optimizing the CapEx side, the capital expenditure of the AI investment wave.
Got it. Volume and speed for the new builds. What about EME, the geographic giant?
EME gives you diversified leverage. They're in 17 data center markets, remember. Their specific strength, where they really shine, is in the mechanical complexity of cooling these facilities. They're deep into designing and installing the huge chiller plants, the specialized ductwork. They're tackling advanced liquid cooling tech needed for these hot new AI chips. Their 25% exposure is really about the heavy-duty mechanical engineering needed to keep both the lights on and the chips cool.
Okay. And IES, they seem like the real niche technician here.
Absolutely. IESC is pure play leverage through that deep technical specialization. They're less about the building shell, more about the specialized tech inside the data center. We're talking complex networking, communications cabling, providing custom hardware solutions like those generator enclosures we mentioned. They're vital for making the data center actually function once the structure is up. That's why their communications segment growth is just off the charts.
Makes sense. And then LMB, the outlier again. How do they plug into the AI story?
LMB offers the highest resilience leverage. Their focus is entirely on the operating expense, the OpEx side of the data center lifecycle. Think maintenance, retrofits, R&R after the facility is built and running.
So keeping the existing ones humming.
Exactly. Once a data center is operational, that maintenance work ensuring uptime, power reliability, it's absolutely non-discretionary. It's mission critical. This OpEx focus makes LMB inherently the least cyclical exposure to the AI boom. If new construction slows down for whatever reason, those existing data centers still need constant maintenance. That gives LMB tremendous downside protection.
That difference, CapEx velocity versus OpEx resilience, that's a really key distinction for listeners. Now let's tackle the big constraint everyone faces, the labor shortage. It's the elephant in the room, limiting growth across the board. How are these four companies building an operational moat to actually execute projects given this constraint?
Yeah, this is where you really see the strategic differences play out. FICX, as we said, is tackling it head-on by moving labor off the unpredictable job site and into the controlled factory. Modularization isn't just for speed. It's a direct strategy to combat the field labor scarcity. The big challenge for them, of course, is keeping that huge 3 million square foot factory capacity sold out and productive.
Right. What about EME? With 100 subsidiaries, managing labor must be incredibly complex. How do they drive efficiency?
EME actually provides a really powerful example of boosting productivity through technology and scale. They track a vital metric internally. Their man-hours are growing only about 1/3 to 1/2 as fast as their total revenue growth.
Whoa, hang on. Revenue growing 2x to 3x faster than labor hours. How?
It signals massive efficiency gains per worker. They achieve this primarily through sophisticated use of VDC, virtual design and construction, and BIM, building information modeling.
Okay, VDC and BIM. For listeners maybe not familiar, what do those actually let them do in practice?
Think of BIM like creating a super precise 3D digital blueprint of the entire project before anything is built. It models every electrical conduit, every HVAC duct, every pipe run, all in 3D space. Then, using VDC, they run clash detection in the computer. It finds everywhere a pipe is going to hit a beam or where ducts conflict with wiring, thousands of potential problems.
So they solve problems digitally first.
Exactly. By fixing these clashes in the virtual world, they avoid incredibly costly rework, wasted time, and wasted materials out on the actual job site. This tech edge, combined with how they leverage their large unionized workforce, about 63% of their 40,000 plus employees are union for smart labor planning. And that's what creates that huge productivity gain. That's how you get 2-3x revenue growth on man-hour growth.
That's a powerful efficiency engine. Okay, what about LMB? Smaller scale, high margin focus. How do they manage labor?
LMB's approach is different. They focus on retaining and developing a smaller, highly skilled, often unionized base, about 45% unionized. Because their work is complex, critical maintenance, they just cannot afford high turnover. You need experienced people who know the systems, so they actively manage talent. The sources mention a 43% reduction in salaried staff attrition since 2021, driven by strong internal development programs. For them, it's about quality and retention, ensuring they have those specialized teams ready for complex maintenance tasks.
Okay, different strategies for tackling labor. Now let's get to maybe the most revealing metric, the operational moat reflected in the margins. We've got LMB leading the pack at 13.5% operating margin, then IESC at 12.5%, FX at 11.2%, and EME trailing at 9.4%. Why is LMB, the smallest player by far, capturing the highest margin premium?
While high operating margins fundamentally signal superior pricing power, they signal you're offering specialized, non-commoditized expertise that customers value highly. LMB's 13.5% margin is driven almost entirely by that successful ODR pivot. Remember the heart surgeon analogy. When you provide owner-direct, rapid response maintenance on absolutely critical infrastructure, the work is urgent, it's non-discretionary, it's vital for keeping that facility running. Customers willingly pay a premium for that reliability and speed. That creates a margin profile that traditional construction work, always subject to competitive bids, just struggles to match.
Okay, that makes sense for LMB, but IESC's margin is surprisingly close behind at 12.5%, even though they do a lot of new construction.
Yeah. IESC's 12.5% margin comes from their specialized construction expertise, but specifically in that high-tech communications infrastructure niche. They're not just bidding on standard HVAC jobs, they're providing highly engineered solutions, complex power switching gear, generator integration for data centers. That deep technical specialization allows them to command better pricing. And we saw the proof. The communications segment gross margin leaped from 19.3% to 24.4% just recently. Specialization pays.
Right. And finally, FX and EME, the giants in terms of revenue and scale, but their margins are structurally lower. Remind us why.
Those margins, 11.2% for fix, 9.4% for EME, while still strong, are structurally lower simply because of the nature of very large-scale construction. They take on huge, multi-year, incredibly complex projects. These inherently carry more execution risk and face intense competitive bidding pressure. It's harder to maintain super high margins on those mega projects. And specifically for EME, as we discussed, their reported margin is further suppressed by that constant non-cash amortization expense from all their acquisitions. They swallow an $87 million accounting drag just from that. FX's margin, on the other hand, fueled by their modular efficiency push, seems more purely operational.
Okay, this comparison brings us right to the investor's bottom line. What are the valuation trade-offs here? Looking at the blended forward PE ratios, there's a definite spread. FX is way up there, around 34 times forward earnings, then LMB around 31 times, IESC at 30 times, and EME is the lowest at about 27 times.
Right, and those multiples really tell a story about what the market values in each company, growth speed versus stability versus profit quality.
Yeah.
You're paying for a specific kind of exposure.
Explain the top end. Why is FX commanding that high 34 times multiple?
With IFIX, you're paying that premium because the market is heavily rewarding high, seemingly predictable growth. It's powered by that proprietary execution capacity of the modular factories. They have the highest direct volume leverage to the data center boom right now. And that huge investment in 3 million square feet of capacity seems to validate their ability to deliver faster than competitors. So investors are betting on the velocity and consistency of that volume growth.
Okay, premium for speed and volume. What about EME at the other end, the lowest multiple at 27 times?
EME represents the most stable, diversified growth profile of the group. It trades lower for a few key reasons. One, its sheer size makes explosive hypergrowth much harder to achieve. Two, as we've hammered home, that margin is structurally held back by the ongoing amortization from acquisitions. So it's seen as the most conservative way to play the sector, offering broad resilience rather than pure play speed. The market applies a discount for the integration complexity and that accounting drag.
Makes sense. And IESC and LMB are clustered in the middle there, around 30-31 times, reflecting their specialization and margin quality.
Exactly. Those mid to high multiples for IESC, 30x, and LMB, 31x, show that investors clearly value their specific margin moats. IESC gets its premium because its specialized tech construction is driving that incredible 55% segment revenue growth. The market pays up for proven technical expertise winning big contracts. And LMB gets its premium for successfully executing that pivot to the high-margin, sticky ODR services model. Here, you're paying for profit quality and the resilience of that recurring revenue, not just raw volume.
Okay, let's stress test these models. Let's talk downside protection, maybe call it AI immunity. What if the AI and data center new construction boom hits a wall? Maybe power grid constraints bite harder, or there's a temporary pause in capital spending. In that scenario, who is best protected and who faces the biggest hit?
Well, the highest risk but also highest reward players in that scenario are clearly FixX and IESC. They are the most leveraged to the CapEx side of the equation, that new construction volume. If clients suddenly delay those big modular projects for FixX or those specialized tech installs for IESC, it hits their large backlogs and high-growth segments immediately. You can see a potential CapEx cliff for them.
Okay, so they feel the slowdown fastest. Who weathers that storm best?
The best protected would be EME, simply due to its vast diversification across so many different industrial, institutional, and service markets. They have more cushions. And critically, LMB, because of that ODR focus on operating expenses, OpEx. LMB's revenue, remember, is tied more to the ongoing operating budget of existing critical facilities. Maintenance, retrofits, emergency repairs, that work is essential and tends to be unavoidable, even if new construction pauses. The revenue stream is fundamentally more decoupled from the boom and bust cycle of new builds.
That's a key safety factor. Before the final verdict, let's just quickly recap the core sector risks that impact pretty much everyone here, beyond the company's specific issues like governance or M&A drag.
Number one, without a doubt, is labor and talent shortages. All the sources flag this as the universal primary constraint. It directly limits the rate at which all four companies can grow. It drives up costs. It forces that continuous investment in innovation modular VDCBM just to keep executing. Number two is broader cyclicality, especially impacting the parts of their businesses tied to new construction. We see that right now, for example, in IESC's residential segment, which sources note is seeing weakness due to higher mortgage rates slowing down housing.
And we have to mention LMB's unique liability one more time.
Yes, absolutely. The unique structural risk specifically for LMB remains those multi-employer pension plan liabilities, MEPP liab. Even though they're a high-margin specialist, being part of 50 of these plans means they carry a share of the responsibility for any future underfunding across those plans. While it might not be an immediate cash drain, it represents a potentially very large, long-tail financial exposure that has to be factored into their long-term risk assessment.
Okay. We've defined the risks, analyzed the rewards, looked at moats, efficiency, resilience. Based on everything we've unpacked from the source's competitive edge, operational strength against labor issues, resilience against downturns, who emerges as the single best positioned player right now.
Look, FixX is the clear velocity leader, the growth champion, but that comes with the highest cyclical risk, and you pay for it with that premium 34x multiple. EME is the incredibly diversified, stable giant, offering safety but at the cost of lower margins and growth potential. However, if the goal is disciplined growth that delivers both superior operational efficiency and maximum resilience against the inherent cycles of construction, the verdict has to lean towards LMB. Their strategic pivot to high-margin, recurring ODR revenue has created what looks like the most robust, resilient, and, you could argue, fundamentally superior business model in this sector right now. They've successfully de-risked their business away from transactional construction bids towards those sticky, indispensable owner-direct services. It's proof that sometimes margin quality can indeed trump sheer scale.
Risk defined. Portfolio protected.
You know, as we wrap this up, looking at just the immense amount of capital pouring into this sector for the AI boom, all the new data centers, the advanced cooling, the huge power demands, maybe hold on to this final thought. The immediate race, yes, it's about building the boxes and the infrastructure as fast as possible. That demands modularity like Fix offers and sheer volume. But the long-term winner, the company that really delivers sustained shareholder value over the next decade, it might not be the one that builds the most new stuff during the CapEx boom. Instead, maybe it's the company that proves most efficient and reliable at servicing, maintaining, and securing all that critical power and cooling infrastructure after the construction dust settles. And that really points towards the model with the highest margin, the least cyclical revenue stream, LMB's owner-direct relationships, tied directly to facility OpEx. That might just be the ultimate safe harbor to finding long-term financial success in this M&E sector, even after the initial building frenzy cools down.
A fascinating point. Maintenance over majesty, maybe. Resilience over raw volume definitely gives you plenty to think about. Thanks for joining us for this deep dive, this financial investigation.